Welcome everyone. Welcome to today's episode of the Market Wrap. I have with me Mr. Pankaj Pandey. And sir, this was yet another week. We stayed near the highs. What is the outlook on the markets right now?
Yeah, hi, good evening, Vishu. Yes, after hitting 26,000 kind of a levels, what we are seeing is market have ended in this particular week on a flattish note at around 25,700 kind of a levels. Largely, I think overall sense was that some bit of a consolidation was expected. Then I think nothing major happened also on the US-China trade related front. So that also sort of kept the market subdued. And since we had already seen a rally in large caps, so which is why mid caps are sort of doing well. So mid caps gained about 1.5%. We're clearly seeing sector rotation sort of happening. Largely, PSU banks have done well, whereas private sector banks have taken a backseat. Oil and gas, metal continues to sort of do well. Our sense is that consolidation could still sort of pan out because you really do not have much to sort of look forward because Fed meet also was sort of subdued for the markets because while Fed delivered 25 bips kind of a cut, but December cut is still a sort of a question mark. So overall sense is that market will consolidate at current kind of a levels. Any sharp weakness in the market is an opportunity to buy because you also need to understand that we have already seen a 1500 point kind of a rally in the market. So that is one of the sharpest rallies which we have seen in the recent past months. And those have been sort of contributed by sectors like, say, banks and IT. Now, banks and IT and auto are sort of witnessing a sector rotation. So these are the sectors or segments which are not performing. And what where we are seeing clearly the performance coming from is other sectors like, say, metals, PSU banks, oil and gas. So we're clearly seeing that sector rotation happening, and which is good for the markets because that builds a resilience into the market. And I think what is also seen is that the FPI positions or FI position in the Nifty or the kind of shorts they were carrying, they've reduced their shorts by half. This kind of selling which used to happen is no longer happening. So yes, there are some positives which are there in the market, which is why the markets are at current levels. And overall sense that once this consolidation gets over, we should see better numbers or better levels for the Nifty going forward. 26,300 should get taken out in this particular month. Uh, Although there are some factors to sort of watch for next month because you will have next week you will have monthly auto sales numbers. We also need to see the FPI trends. Nothing much has happened despite a lot of anticipation on the India-US tariff negotiation front. And earning season is still sort of going on, so we are still seeing quite a lot of action depending on how the earnings are taking shape. And gold, I think gold and silver has sort of consolidated. We have been sort of suggesting people to sort of not really go chase at higher levels. And that is still the case because we have seen literally 50-60% kind of a rally in gold and silver too soon and too sharp. So there we are carrying a view that it should consolidate. So largely, I think less amount of triggers or lesser triggers should lead to more consolidation in the market, and we should see more of a stock-specific action.
Absolutely. So there's also been a significant rally in the PSU banks. What is the reason behind it?
One, there is definitely a sector rotation which is happening, Vishu. The other is that I think there are a lot of improvement in the fundamentals of PSU banks, the way they used to operate. Now, one, there is a revival in their fundamentals. They're no longer seeing the kind of volatility in their margins the way private sector banks are witnessing. And overall sense is that the valuations, despite the run up, are still sort of reasonable. So there is further room for PSU banks to sort of do well. And highlight a couple of structural points. So one is when we look at from the lending perspective, PSU banks typically were corporate lenders, but that has sort of changed. And just to sort of highlight 2018, the biggest of the all bank, SBI, for them, the retail agri MSME segment used to contribute somewhere about 49% of their portfolio. Now it is 67 odd percent. We know that retail agri MSME portfolio does not witness the kind of volatility what you see in a corporate book. And not only SBI, even you look at the second best bank, so for example, Bank of Baroda. So there also The RAM segment is about 60 to 63 odd percent. It used to be about 52 odd percent, say, for 5 years back. So clearly there is a shift there. You will not see a case where you are going to see far more bigger slippages and accordingly higher provisions. Let's look at the NPAs. Now, NPAs in the worst of the cycle, gross NPAs was somewhere about 15 odd percent. Now, that number has come down significantly to 2.5%. And with provisioning, the net NPAs are half a percentage, so which is in line with what private bank counterparts are also sort of seeing. Relatively, PSU banks hold better CASA, so their CASA proportion is 30 to 40 odd percent. And I think one more thing which might help PSU banks is that the government is looking to sort of allow or raise the FI limit from say 20% to 49%. And if I sort of add it with the perspective that government is looking to create bigger banks, I will not be surprised if we get a phase where we get a decent amount of passive inflows into PSU banks. So that way, I think a combination of these things, all these things is helping PSU banks to sort of do relatively better and they can continue to sort of do well. What we like is again some of the banks like say SBI, Bank of Baroda, Canara Bank, Bank of India, Indian Bank. Though some of them have rallied, but our sense is that a lot of these banks are still good even at current levels.
Right. So another sector that has been undergoing a phenomenal change, the very nature of this sector is completely transformed, is power. Because the way power has been operating in this country, all across the world, is now becoming more and more green. Now, how do we take this from an investor perspective?
So Vishu, power is becoming core to a lot of sectors, not only in India, but I think globally. And I think next 5, 10 years or probably longer, if there is one sector which is going to witness a lot of action, that is going to be power sector. Because yes, it also helps in energy security. Now, in our case, we have already seen changes happening. So, for example, we have recently crossed a 500 gigawatt kind of a capacity. Within that, half of it is contributed by renewable energy. So renewable energy has seen a threefold increase. So in say 2014, renewable energy used to about 81 gigawatt. That is now 257 gigawatt. And within renewable energy, solar is half of it. And in solar, again, overall sense is that this year we could be adding about 30 to 40 gigawatts, and on the wind side, about 6 odd gigawatt. Generation is definitely sort of seeing a good amount of traction. On the transmission side, the government has already lined up one of the biggest capex of nearly about 9 lakh crores. So from that perspective, that segment is also witnessing good amount of traction. I think the third structural leg is the distribution piece, which is a largely a state subject, and that is where the most of the pain lies. And discoms in general carry losses exceeding 7 lakh crores, which is massive. Now, unless that does not change, this sector cannot run. And I think we are seeing some policy announcements are expected there. So I think on the distribution side, clearly the government is looking to sort of allow multiple players for a particular distribution network. Earlier, you had only a state-owned discom which was there. And if private player was given a license, they need to build their own distribution network. And obviously, it's a sort of a doubling of a distribution network and with relatively lesser ROIs for it. So I think government is looking to allow multiple players. It could be government owned, it could be private. Using the same distribution network. So from that perspective, things can become a lot more efficient, better. So that is one. The other is government is looking to allow more frequent revision of power tariff. Earlier, power tariffs used to sort of get revised in a year. Now, electricity commissions will be able to sort of revise tariff. And also, they're looking to sort of eliminate the cross subsidy burden because a lot of states come up with free power and usually it is at the expense of industrial customers. So that is a practice which the government is looking to discourage. And just like GST Council, government is looking at Electricity Council. So that way things are, or the implementation of the policy will or can become better. And then what the government is doing is that they have widened, or they are looking to widen the definition of renewable energy with non-fossil sources. So again, you'll have, besides solar, wind, you will have nuclear, you will have pump storage, green hydrogen-based battery storage. So all of it will come, and obviously the purchase obligations will carry, and anyone who's sort of, or any discom which is not meeting those norms, again the penalty charges are at about 10%. So which means that 35 to 45 paisa of the penalty is what is going to be charged if they don't really adhere to that. And since they are carrying huge amount of losses, so government is looking to sort of come up with a bailout package of nearly about a lakh crore, obviously with certain terms and conditions. So from that perspective, there is some hope which is sort of getting generated that this sector will become better, because whether it is the power itself, or whether you look at auto, or whether you look at the kind of data consumption which is happening, or entire AI is again dependent on how stable the power systems are. So from that perspective, it becomes a lot more important for the structural competitiveness of the economy. And I think if this works out, I think power sector is expected to sort of witness a lot of traction. Now, a lot of players can come in. As of now, we are liking players like, say, Tata Power, CESC, Adani Power, or Torrent Power, besides NTPC or Power Grid. So I think this sector is definitely going to witness a lot of policy action for good.
Absolutely. Speaking of policy actions that will determine our greenliness or being eco-friendly, we also have the Montreal Protocol and its amendment, which states that we have to get rid of this HFCs as well. Where do you see the impact of this in the markets?
So I'll just highlight a specific segment, Vishu, because we have seen Naveen Fluorine coming out with pretty fabulous set of numbers, and stock doing very well from a price performance perspective. And obviously, there is a leg to what you are highlighting. Now, one is the global dynamics for the manufacture of R32 refrigerant gas, which is typically used in your room air or car air conditioners or refrigerators, is changing because of the restrictions which are imposed on who will sort of manufacture. And as per the global agreement, the production of these greenhouse gases such as HFC, like, say, for example, R32, now it has to go down in phases by 2047. And for developed countries, it needs to start, it has started coming down from 2019 onwards. And for India, it has to sort of come down from 2032 onwards. So in between, what is happening is that supplies are getting sort of restricted, and which is where Indian companies are looking to sort of up the capacity and sort of capture some of those opportunities. And I think some of these companies are highlighting or looking to sort of capture this opportunity. And because typically every country will, or company will have a quota basis what kind of production they have done in the period, say, 2004 to 2026. And which is why we're seeing a lot of companies looking to ramp up the capacity. So Navin Florian is the recent one. They're looking to put to 40 odd crores, and they're indicating a revenue potential of nearly 800 odd crores on the higher side. And they're looking to add capacities of about 15,000 odd tons. Currently, they're sitting on about 9,000 kind of a capacity. SRF is sitting on some 30,000 ton kind of a capacity, and Gujarat Fluor Chemicals is also sitting on some 20,000 ton kind of a capacity. So I think this entire restrictions which is imposed on global players is creating an opportunity for Indian players, and which is why some of these companies are going to be in a sweet spot for some period of time. And our sense is that even the pricing of R32 gas is going to remain at elevated levels. And which is why we want to believe that both or all three of them, which is SRF, Naveen Fluorine, and Gujarat Fluorochemicals, are buy at current levels. We have already come out buy on the two stocks, and Gujarat Fluor is another company. Once the results are out, we would sort of look at, but previous recommendations have been a buy. So all three companies are looking attractive to us. So I think, yes, all these three companies are in a sort of a sweet spot.
Absolutely. Sir, let's move on to the results that were announced this week. Let's start with the liquor sector. I think United Spirits and Radico Khaitan came up with results this week.
Oh yes, so Vishu, we have been liking liquor space for quite some time. I think Radico Khaitan we had sort of recommended as hidden gem for some time back. Allied Blenders yet to come out with numbers, so that was recommended in Muhurat. Now coming to Radico Khaitan, numbers came out good. The company witnessed 34% jump in sales. The volume growth was pretty impressive at 37 odd percent. Now, the segment which we largely look at is the prestige and above segment. So that contributes nearly 38% of the volume. There, the growth rate was about 24 odd percent. And volume growth is about 22 odd percent. The regular segment witnessed a lot more higher growth at 83 odd percent because there is a liquor policy change in Andhra Pradesh. And but over a period of time, that should sort of normalize. So largely, the growth is going to be anchored by the prestige and above segment. And since that segment does well, the margin improves. Something similar happened. EBITDA margins improved to about 16 odd percent. Profit growth was somewhere about closer to 70 odd percent. Now, overall sense is that company will continue to sort of deliver double-digit kind of a growth. So I think growth story is intact. We have revised our target prices on Radico Khaitan to 3,710. I think United Spirits also came out with a relatively better set of numbers compared to their own expectations because a company witnessed 11% kind of a revenue growth. And prestige and above segment, though overall it contributes a significant chunk, grew by 8 odd percent. And popular segment for them grew by about 6 odd percent. Now, for them, there were specific challenges. So, for example, Maharashtra contributes 25% of their sales, and that witnessed a decline because Maharashtra had sort of raised the prices. And then the company re-entered the Andhra market, and so that sort of helped or mitigated that decline to some extent. And but relatively, company did well from gross margin nearly expanding 200 bips, EBITDA margin really improving about 300 odd bips or slightly more than that. And as a result, profit growth was good. Mind you, this company also carries the valuation of 515. So yes, if the numbers for Maharashtra stabilizes from here on, I think this company can also do good. But as of now, I think Allied Blenders and Radico Khaitan is what we prefer.
Right, sir. How about the realty sector, sir?
So real estate as a sector has witnessed a good price performance. The stocks have had taken a good amount of beating. But when we look at some of the numbers which have come by, I think there's not that kind of a disappointment the way numbers or the way prices had sort of declined. One overall sense is that when you look at the Q2 numbers, I think one you had elongated monsoon. Then last 2 years the price hike have been quite steep, and then there were challenges in terms of some of the pockets, like say for example segments like say Bangalore or cities like Bangalore or others where IT presence is higher. So those getting impacted. But when you look at the premium segment of the market, whether it is sales booking of Aditya Birla Real Estate, so their Worli project witnessed 320 crore worth of sales. Oberoi again 360 West, Worli again 446 crore kind of sales. DLF Camellias 1600 crore kind of a sale. So all the premium or super luxury segment continue to sort of do well. The other sense is that in the second half, we are expecting a lot of launches, and that should sort of lead to most of the companies meeting their guidance. So, for example, I think overall sense is that in the second half, Aditya Birla Real Estate, the overall guidance is expected to be met. Brigade is expecting to launch about 8,000 odd crore worth of projects in the second half. Their overall guidance for FY26 is 9,000 odd crores. DLF has already achieved 70% of the target, so they're comfortable with a 20 to 22,000 crore kind of a pre-sales number. So numbers are not so subdued. The way prices have been sort of subdued, and I think once some revival happens on the IT front, I think real estate as a segment can also make a comeback. But largely, it's again driven by the premium segment. We need to see more broad-based growth for a better or a sustainable performance in real estate.
Right. ITC also came up with results. Lots and lots of investors are looking forward to it. What did the results say?
So, Vishu, when you look at numbers, there is a top line decline of 3.5%. But I think we need to see the agri business numbers, because the agri witnessed a decline of 30% again because of the higher base. If you sort of strip out agri, the overall growth rate is 9% better than some of the peers. The cigarette for them continues to remain stable, 5 to 6% kind of volume growth. So that has been the case for past few quarters. Non-cigarette growth has been about 7 odd percent. I think in non-cigarette business, in the FMCG side, the margin needs to improve. I think margin is at about 10 odd percent, needs to improve because peers are making a lot more better margins. And second half is where we are expecting slightly better set of numbers. Relatively valuation wise, it is a slightly better place, so which is why we are recommending this as the buy with a target price of 505.
Right, sir. And of course, another large cap, we have Larsen and Toubro. What did the numbers say?
So L&T we had recommended in our Muhurat pick as well. Numbers were quite steady. In fact, order inflows are quite robust, up about 45 odd percent. So they got order in excess of 1 lakh 15,000 odd crores. Total order book is about 6.6 lakh crores. Now, company has guided for 10%, but our sense is that with the kind of pipeline which is there, they could easily be sort of overachieving that. So that is not the overall worry. In fact, our sense is that with better execution, the company can deliver a lot more better set of numbers in terms of we are looking at 15% kind of a revenue growth. I think the some of the other aspects which were pain point for this was the Hyderabad Metro, which was loss making. So I think company has finalized terms wherein they'll transfer that asset to government of Telangana. So again, that should sort of free up some resources. Their ROE profile has already sort of improved. Plus, it has been sort of winning orders on almost on a daily basis. So overall sense is that things have been good. We have in fact upgraded our target price to 5,020. So I think this is one of the best large caps to own, and one of the must large caps to own as of now.
Right. And finally, we also have Hyundai Motors. What did the number say there?
So we had both Hyundai and Maruti numbers. So largely Hyundai numbers were flattish YY Q on Q. Maruti growth was about 2 odd percent, so largely flattish. Margin wise, Hyundai did very well, about 14 odd percent, whereas Maruti's margins were 10.5%. And overall, I think between Hyundai and Maruti, so Hyundai has been sort of doing relatively better. They have come up with a capex plan of 45,000 odd crores. They are looking at a top line of 1 lakh crores. 30% is expected to come from exports. And I think no one in the auto side, see, compared to a 2 or 3% kind of a volume growth, people have raised that to somewhere about 5 to 6 odd percent. But no one is, or probably 8 odd percent, but no one is looking to commit for a double digit kind of a growth. They're still in a sort of wait and watch situation. So that can sort of bring about a surprise if the demand sustains post festive season. Otherwise, auto sector continues to sort of do well. Relatively, I think Hyundai has been commanding far more better P multiples because margin profile is better. They're a lot more aggressive compared. So for example, we give a 30p multiple to Hyundai. Compared to that, we give for 28 for Maruti. But since we like this sector overall, we have a buy rating on both of them.
Right. Finally, let's move on to our most awaited segment, Hidden Gem of the Week. Which will it be this time, sir?
So I'm recommending auto ancillary stock called Lumex Auto Technologies. See, the reason for recommending this stock is that the stock is a pretty steady performer. Now, this company makes integrated plastic molecules plus their control systems and other mechatronic kind of a product is what they make. And for them, M&M and Bajaj Auto are the key customers. Incidentally, both of them are doing very well. Besides that, Maruti and Tata Motors are the other big customers. So in fact, Bajaj Auto and M&M contribute nearly 44% of their sales. And since this segment is expected to sort of keep doing well, whether whosoever does well, Lumax is expected to sort of do well. Now, reason for liking this company is that this company is sitting on a good order book of nearly 1,500 odd crores. 40% is largely linked to the EV side, so there is no risk of any kind of a change in platform. What we like about this company is the stability in the growth rate. This company has been very stable. In fact, next 4 5 years, this company is looking to sort of deliver a 20% kind of a growth. So from 3,500 crore kind of a revenue, they're aiming for about 10,000 crore kind of a revenue by FY31. Margin profile is okay at about 13.5%. They're looking to sort of 13%. They're looking to take it up to somewhere about 16 odd percent. And annual capex of nearly about, I think, 18 to 2,000 odd crores in the next few years. So this is one of the few companies which has done a lot of tie-ups, looking to sort of introduce newer products, and which is why I feel that in auto ancillary, this company makes a good case from a portfolio perspective, which is why we are recommending this with a target price of 1,285.
Right. Well, that was it for this time. Thank you so much, Pankaj sir, for your insights, and thank you so much everyone for watching. If you have any questions, please do put them up in the comments and we'll try to get back. Thanks again.
Thank you so much.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.